So I know we've had you on before, and I think the first time these price points were just insanely low, and I'm sure they're not as high as they are today in Canada as an example. But what can somebody expect? Let's just talk about numbers. Like, what are you buying? What price point, and what does that look like?
Well, look, we have some different asset classes that we operate in. Surely, where we've had the most success is in the single family market in sort of B class. We call them quote unquote high appreciation hot pockets, right? In those regions, we're operating mostly in colonial homes. Typical cost for an investor coming in would be between 130 to 160,000 US. Okay, you could either buy outright and then refinance after purchase in 6 months. You do a cash out and scale, or we have more accessible purchase financing options for foreign nationals to come in and buy with a 30% down payment. After that, there is a more premium class of properties. The advantage to these ones is, and we'll talk about this a little later, I think, is there's potential for a little bit more uh, equity capture from purchase due to construction and neighborhood class. So they can range anywhere from that sort of 160 level up to around 250,000 US. Okay. Below that, there is a very stable entry level asset that typically runs around 95 to 100,000, typically a bungalow. They're very attractive cash flow assets, low maintenance, but they're not always the best for, or should I say, as successful with the scaling model, because when it comes to the US lenders, they like to see a little bit higher valuation on the appraisal, and they just don't perform quite as well due to the fact they're not going to be in quite the same neighborhood quality.
Mm-hmm. Anything you want to add on your end, Wojtek?
Yeah, I think that we've really as the market has matured, we've noticed that there is more equity to be captured by investors in these slightly more expensive properties. So for instance, you can buy a property right now with for 130,000 and end up with about 8-9% cash on cash return. But if you we had clients who are buying $225,000 assets that are worth about 275, so they're able to purchase at 225, even with financing, with 30% down. And 6 months later, they're able to get another appraisal. And then that appraisal value, of course, is taken when doing the refi with the same lender. And what's been really, really successful with this particular asset class is that because we're working directly with the lenders now. The loan fees have been virtually zero. They're charging 0.5% of the loan value, whereas it used to be 3 or 3.5% before that. So so a lot of the equity capture was eaten up by lender fees. Right now we're having a lot of success. Our clients are able to experience the equity lifts, which turn into higher LTVs. And so, we have clients who are able to come in with $150,000, $175,000 in cash and end up with 4 $250,000 properties at the end of the year in a 12-month period. And they're thrilled, and they're all cash flow positive, and they're all in even better neighborhoods than we were operating in before, with higher appreciation potential. These assets are located closer to downtown, 5-10 minute drive from the downtown core, and that's where we've seen the highest rent growth and the highest appreciation right across the board. So it's been fantastic. It's been really great in the last 12 months. I know a lot of your listeners may be concerned about the increasing interest rates and about what that environment looks like and the impact that it's had on cash flow. What we have really been focused on the last 12 months is really controlling other costs, such as insurance. We've gotten our clients half the insurance costs that they were paying prior, in the last 6 months. And that has had a very positive impact on the cash on cash returns, even though the interest rates are a little bit higher. And also the elimination of the lender fees. That combination has virtually been able to produce the same returns for our clients as we have been over years. And as James mentioned, the impact in the US of the high interest rates has been present on higher value properties. And of course, you know, the $2, $3, $4 million homes, well, those are, the prices have been impacted. But in the market, in the pure investment market of $100,000 to $150,000 properties, we have actually seen steady increases over the last 2 years. You know, they're not in the high double digit appreciation that we have experienced, but we're still getting, you know, 8, 9, 10% increases on the properties, you know, despite the environment. So it's very exciting, and we've been very busy, you know, for the last 8 months. Like, it's, you know, because of it, I think so. And our clients are having a lot of success.